Hey everyone, welcome back. And if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, what I am about to show you is something almost nobody is talking about. Let's get into it. The last 3 times this number hit this level, the stock market lost 25% or more. In 1929, it lost 83%. It took 25 years to recover. In 2000, the Nasdaq lost 78%. $5 trillion gone. In 2021, the S&P 500 dropped 25% the following year. Tech companies fired 260,000 people. Right now, that number is higher than all 3 of those peaks. The highest it has ever been in recorded history. And it is not alone. A second indicator, built by a Nobel Prize winner using 155 years of data, is also at its highest level since the dot-com bubble. Both numbers flashing at once has happened exactly 3 times in the last century. Every time, a major decline followed. This is the 4th time. Here is what the numbers are, what they measure, and what they mean for your retirement account, your job, and the price of everything around you. The first number is called the Buffett Indicator. Warren Buffett, the most successful investor in modern history, once called it probably the best single measure of where valuations stand at any given moment. He said that in a Fortune magazine interview in 2001. The Buffett Indicator is simple. Take the total value of every publicly traded stock in America, divide it by GDP, the total economic output of the country. That gives you a ratio. If the ratio is around 75 to 90%, the market is fairly valued. Stocks are priced roughly in line with what the economy actually produces. If the ratio crosses 100%, the market is getting expensive. Stocks are worth more than the entire economy produces in a year. If the ratio crosses 200%, Buffett himself said, "You are playing with fire." As of February 25th, 2026, that ratio is 220.5%. That is the highest reading in the entire history of the indicator. Higher than the dot-com bubble, higher than the pre-pandemic peak, higher than the post-COVID rally that crashed in 2022, and it is not just above the fire line. It is 20% above it. To put that in perspective, every dollar of economic output in America is now supporting $2.20 of stock market value. The economy would have to grow by more than double just to justify current prices. Now, here is why this matters even if you do not own stocks. When the stock market is this disconnected from reality, it creates a gravity problem. The higher it goes, the harder it falls. And when it falls, it does not just hurt people with brokerage accounts. It destroys retirement savings, it triggers layoffs, it freezes lending, it pulls the entire economy down. In 2000, after the Buffett Indicator peaked near 200%, the S&P 500 fell 49%. The Nasdaq fell 78%. The economy lost nearly 3 million jobs. It took the market 7 years to recover. In 2022, after the indicator approached 200% again, the S&P 500 dropped 25%. The Nasdaq fell 33%. Tech companies laid off hundreds of thousands of workers. Mortgage rates doubled. Now the indicator is at 220%, 20 points higher than either of those peaks. The second number is the Shiller CAPE Ratio. This was created by Robert Shiller, a Yale professor and Nobel Prize winner. It measures whether stocks are expensive by comparing prices to average earnings over the last 10 years, adjusted for inflation. The historical average for the CAPE ratio is about 16. When it gets above 25, the market is considered expensive. When it gets above 32, every single time in 155 years of data, a major decline followed. Right now, the Shiller CAPE is 40.2. That is the second highest reading in 155 years. The only time it was higher was in December of 1999, when it hit 44.2, just months before the dot-com bubble burst and wiped out $5 trillion. The job market created almost no jobs in 2025. A Federal Reserve governor said the real number is probably negative. The bottom half of American consumers is struggling. Household debt is at a record. Credit card delinquencies are rising. Real wages for the median worker have barely kept up with inflation over the past 4 years. And the market is 20% higher than it was before the dot-com bust. That combination, extreme overvaluation plus economic weakness underneath, is the most dangerous setup in market history. Now, here is the part most people are missing: margin debt. This is the money investors borrow from their brokers to buy stocks. It is essentially leverage. And when it unwinds, it does not unwind slowly, it unwinds all at once. In October of 2025, the latest available data from FINRA, margin debt hit $1.18 trillion, a record. But the number itself is not the problem. The problem is the speed. Margin debt grew 45% over the past year. The S&P 500 grew about 19%. That means borrowed money is growing more than twice as fast as the market it is propping up. That gap between debt growth and market growth has appeared only a few times in modern history. Before 1929, before 2000, before 2008. Every single time, the debt unwound violently. Because when margin calls start, forced selling begins, and forced selling triggers more margin calls, and more margin calls trigger more forced selling. It is a chain reaction that feeds on itself. In October alone, fund managers sold $43 billion in stocks. For the year, net institutional selling reached $332 billion. The people who manage money for a living are leaving. The people who borrow money to gamble are arriving. That is exactly how the top looked in 1929. And there is one more signal that has veteran investors paying attention. Warren Buffett, the man who created the indicator that bears his name, is sitting on $380 billion in cash. That is the largest cash pile in Berkshire Hathaway's 60-year history. Buffett sold roughly $200 billion worth of Apple stock over the past year. He trimmed his bank holdings. He loaded up on short-term treasury bills, paying 3.6% instead of buying stocks. Buffett does not give market forecasts. He does not do interviews predicting a downturn, but his money speaks louder than any interview. When the greatest investor alive is choosing 3.6% guaranteed over a stock market near all-time highs, that is a signal. A loud one. And he has done this before. He closed his investment partnership in 1968, right before the market fell. He avoided the dot-com bubble entirely and was vindicated when the market collapsed. When 40% of the index is in 7 names, a 10% drop in those names pulls the entire S&P 500 down 4%. And that 4% triggers margin calls, which triggers forced selling, which triggers more margin calls. Michael Burry, the investor who predicted the 2008 housing downturn, has warned that passive investing and index concentration could make the next downturn much worse. Because when money flows out of index funds, it sells every stock in the index at once. There is no differentiation, no analysis, just mechanical selling. And right now, a record amount of money is in passive index funds, more than active funds for the first time in history. Think about what that means. Trillions of dollars are invested not because someone analyzed a company and decided it was worth buying. They are invested because money flows in automatically, through 401k contributions, through payroll deductions, through target date funds that buy the index every 2 weeks, regardless of price. That money does not care whether the Buffett Indicator is at 90% or 220%. It buys at any price. And that constant buying pushes prices higher, which makes the index go up, which attracts more passive money, which pushes prices higher still. It is a feedback loop, and feedback loops work beautifully on the way up, but they reverse on the way down with equal force. So what does this actually mean for ordinary people? 3 things. First, retirement accounts. The average 401k is heavily invested in the S&P 500. If the market falls 25%, which is what happened the last 3 times these indicators reach this level, the average retirement account loses a quarter of its value. For someone with $400,000 saved, that is $100,000 gone. And the people who get hurt the most are the ones closest to retirement, because they do not have 20 years to wait for the market to recover. They need that money now. And if it drops 25% the year before they retire, their entire plan changes. Second, jobs. When the market falls, companies cut costs. They freeze hiring. They lay off workers. In 2022, tech companies alone laid off over 260,000 people. A broader decline would spread layoffs across industries: finance, real estate, retail, manufacturing. The unemployment rate is currently 4.3%. That sounds healthy, but it has been rising slowly. From 3.4% in early 2023. The direction matters more than the number, and the direction is up. Third, housing. When the market falls and the economy slows, housing follows. Mortgage rates are already above 6%. If the stock market drops and drags consumer confidence with it, home sales slow even further. Prices stall, equity evaporates. For millions of Americans, whose home is their largest asset, a housing slowdown hits harder than a stock market drop. Fourth, interest rates. If the market falls sharply, the Federal Reserve would likely cut rates to cushion the blow. That helps borrowers, but it hurts savers. And if inflation is still above target when the decline starts, the Fed is stuck. It cannot cut rates without risking higher inflation, and it cannot hold rates without deepening the downturn. That is the trap. And both indicators suggest the economy is heading straight toward it. And there is one more layer of risk that almost nobody is talking about. The same companies that are holding up the market are also borrowing at a record pace to fund their AI spending. Hyperscalers, Amazon, Microsoft, Meta, Google, issued about $121 billion in new debt in 2025. That is over 4 times more than the $28 billion they issued in 2024. Oracle is expected to spend so much on capital expenditures in 2026 that the total will exceed its operating cash flow by at least 40%. For the first time in roughly 20 years, global fund managers and survey data are warning that large companies may be overinvesting. That means 2 kinds of borrowing are stacked together: investor margin debt on one side and corporate debt on the other. If AI revenue growth slows, or if earnings disappoint, both layers come under pressure at once. And then there are the tariffs. The United States has imposed 10 to 15% tariffs on imports from around the world under Section 122. Those tariffs raise costs for consumers and create uncertainty for businesses. If companies start pulling back on spending because of trade uncertainty, at the same time that the market is at peak overvaluation, the combination could be the trigger that these indicators have been warning about. Tariffs also weaken the dollar, which raises import costs, which raises inflation, which limits the Fed's ability to cut rates to rescue the market. It is a chain reaction of constraints. Every past overvaluation peak had its own trigger. In 1929, it was a financial fraud case in London. In 2000, it was a few missed earnings reports. In 2008, it was a bank failure. The trigger is always different. The setup is always the same. And right now, the setup is complete. Now, a word of balance. Because this video is about data, not fear. These indicators do not predict timing. The Shiller CAPE was above 30 in 2017, and the market kept rising for 3 more years. The Buffett Indicator crossed 200% in 2021, and the market did not peak until early 2022. Some analysts argue that today's valuations are justified by the AI revolution. They say that artificial intelligence will create so much productivity growth that current prices will look cheap in hindsight. Goldman Sachs estimates that AI capital spending will total $1.15 trillion between 2025 and 2027. That is real money flowing into real infrastructure. And the companies at the center of this spending, Nvidia, Microsoft, Amazon, Google, are not paper companies with no revenue. They are among the most profitable businesses in history. Their earnings are real. Their cash flows are real. The question is not whether these companies are good. They are. The question is whether the price you're paying for them today leaves any room for error. And at a CAPE ratio of 40, the answer is almost none. Overvaluation is a necessary condition for a major decline. But it is not a sufficient condition. Something has to trigger the fall: a recession, a policy mistake, a credit event, a geopolitical shock, or simply an earnings miss from one of the 7 companies that hold up 40% of the index. The indicators do not tell you when. They tell you how far the fall can go once it starts. And right now, the distance between current prices and historical averages is the widest it has ever been. Guru Focus, which tracks the Buffett Indicator daily, estimates that based on current valuations, the stock market is likely to return negative 0.4% per year for the next 8 years. Not a slow growth, a negative return for 8 years. That does not mean the market will fall tomorrow. It means the starting price is so high that even average returns will not be enough to justify what investors are paying today. So what should you be watching? 4 things. First, margin debt. If it keeps rising while the market stalls, the pressure builds. A sudden reversal in margin debt, like what happened in late 1929 and early 2000, is often the first domino. Second, insider selling. When corporate executives sell their own company's stock, they are telling you something the earnings report has not said yet. The insider selling ratio has been elevated for months. Third, the VX. This is the market's own fear gauge. Readings above 20 indicate elevated risk. Sustained readings above 25 usually precede major moves down. It has been hovering near 20 for weeks. Fourth, the Magnificent 7 earnings. If any of them signals a slowdown in AI capital spending, which totaled over $400 billion in 2025, the math that holds the entire index together starts to break apart. None of this is a prediction. It is a reading of the instruments. 2 instruments that have been right before every major market decline in the last century are both flashing red at the same time. At the highest levels ever recorded, the market might keep going up for another year. It has done that before. Overvaluation can persist far longer than anyone expects. But the data is clear. The further the rubber band stretches, the harder it snaps back. In 1929, the snap took the market down 83%. In 2000, 49%. In 2022, 25%. The rubber band has never been stretched this far. That is not a prediction. That is math. Now, this channel will continue tracking both indicators, margin debt, and the Magnificent Seven earnings as they develop. If something changes, better or worse, the update will be here. But most people will not see that update. They are not subscribed. They will find out after the fact, after the move already happened. If you learned something from this video that you did not know before, hit subscribe. It is free. It takes 1 second. And it means the next time something moves, you hear about it while there is still time to prepare. See you in the next one.